Central banks play a crucial role in the economy. They control monetary policy, which includes setting interest rates, managing inflation, and ensuring financial stability. However, for a central bank to be effective, people must trust it. This trust is known as central bank credibility. A credible central bank can influence inflation expectations, stabilize markets, and support economic growth. Without credibility, a central bank may struggle to achieve its goals, leading to economic problems such as high inflation, currency devaluation, and financial instability. Central bank credibility means that people believe the bank will do what it says. If a central bank commits to keeping inflation at 2%, for example, businesses and individuals must believe it will take the necessary actions to achieve this target. Credibility is built over time through consistent policies, transparency, and independence from political influence. When a central bank has credibility, inflation expectations remain stable. People and businesses make financial decisions based on the assumption that inflation will stay predictable. On the other hand, if a central bank loses credibility, inflation expectations become uncertain, leading to economic instability. Remember our video on expectations and why they matter for real outcomes. Expectations with a non-credible central bank are all over the place. Central bank behaviour builds or destroys credibility by changing people's minds over how the bank will behave. Central banks have an incentive to say one thing and do another. For example, suppose that inflation is high and the central bank says that it will do all that is necessary to lower it. This would imply that it will raise the interest rate, causing a decrease in investment, a decrease in GDP, and an increase in unemployment. Suppose that you believe the central bank, that means that you think it will do what it says. If we all believe this, our behaviour will be reflected in our actions. We won't ask for a raise, producers won't raise prices to ensure against future inflation, and so on. So inflation tomorrow may be lower just by the fact that we believed that the central bank will do what is necessary. But then, when tomorrow comes, the central bank has an incentive not to do what it said it would, so that it does not have higher unemployment and lower GDP. It's kind of a feint, worthy of Lionel Messi. It fakes left and goes right. Economists call this the time inconsistency problem, the idea that you announce a plan of action, but because people believe you, that changes circumstances, which makes that plan of action less appealing. But we're not stupid, right? The central bank can do this once or twice, but once we get wind of it, we won't believe it when it speaks. And that's a problem. Why? Well, for a bunch of reasons. One of the most important responsibilities of a central bank is controlling inflation. If people believe the central bank is committed to low inflation, they will set wages, prices, and contracts accordingly. This helps keep inflation under control. For example, in the 1980s, the US Federal Reserve, led by Paul Volcker, had to rebuild its credibility after a period of high inflation in the 1970s. By raising interest rates sharply, the Fed demonstrated its commitment to fighting inflation. Although this led to a short-term recession, it restored credibility and led to stable inflation for decades. When a central bank has credibility, it can influence interest rates more effectively. If people trust that the central bank will keep inflation low, they will accept lower interest rates on loans and investments. This helps economic growth. For example, the European Central Bank, ECB, and the Bank of England have built strong credibility over the years. As a result, they can adjust interest rates with minimal market disruption, keeping borrowing costs stable for businesses and consumers. Credible central banks can prevent panic and stabilise financial markets. When investors trust a central bank, they feel more confident in the economy and financial system. This trust helps avoid bank runs, stock market crashes, and other financial crises. A good example is the 2008 global financial crisis. The US Federal Reserve and other central banks took bold steps, such as cutting interest rates and buying financial assets, to restore confidence. Because of their credibility, these actions reassured markets and prevented an even deeper economic collapse. A country's currency value is influenced by its central bank's credibility. If investors trust the central bank, they are more likely to hold the currency, preventing depreciation. If credibility is lost, the currency may weaken, leading to inflation and economic instability. For instance, in 2018, Turkey's central bank faced a credibility crisis when the government interfered with its policies. Investors lost confidence, causing the Turkish lira to fall sharply. Inflation spiked, and the cost of imports rose, creating economic hardship. This shows how crucial it is for a central bank to be independent and credible. A stable economic environment supports investment and growth. Businesses plan for the future based on predictable inflation and interest rates. If a central bank lacks credibility, businesses may delay investments due to uncertainty. In all of these cases, lack of central bank credibility is costly, because if people don't think the central bank will do what it says, it is very hard for the central bank to do its job. In our explanation above, we discussed why the central bank has an incentive to say one thing and do another. And we also talked about why, after a couple of times of fooling the public eventually learns and does not listen anymore. Well, now think of the case when we know the central bank is not to be taken at its word. How does it affect its job? Again, we refer to our video on expectations and why they matter. If the central bank says it will do everything possible to lower inflation, we don't believe it and continue to form our expectations on the basis of the past. Inflation won't come down because we behave as if whatever the central bank says is irrelevant. So workers ask for higher wages, and producers keep increasing prices without taking the central bank's promises into account because they've been burned once or twice. Losing credibility is easy, building it is very hard. How can a central bank maintain credibility? A central bank must be free from political influence to make objective decisions. When politicians control monetary policy, they may push for low interest rates to boost short-term economic growth, even if it leads to long-term inflation problems. For example, Zimbabwe's central bank lost credibility in the early 2000s when the government printed too much money to finance spending. This led to hyperinflation, with prices doubling every few hours. The economy collapsed, and trust in the central bank was destroyed. People and markets must understand the central bank's policies and objectives. Clear communication helps build trust and predictability. A good example is the US Federal Reserve's policy of holding press conferences and publishing meeting minutes. This transparency helps the public understand its actions and increases trust in its decisions. A central bank must follow through on its promises. If it says it will keep inflation at 2%, it must take the necessary steps to achieve this target. Changing policies unpredictably can weaken credibility. For example, the Bank of Japan has struggled with credibility issues due to its inconsistent monetary policies over the past few decades. Despite efforts to stimulate inflation, the public has often doubted its commitment, making its policies less effective. When a central bank loses credibility, the economy suffers. Here are some of the major consequences. High inflation. If people believe the central bank cannot control inflation, prices may rise quickly, reducing the purchasing power of money. Higher interest rates. Investors demand higher interest rates to compensate for uncertainty, making borrowing more expensive. Currency depreciation. A lack of trust in the central bank can weaken the currency, increasing the cost of imports and worsening inflation. A real-world example of these consequences is Argentina. The country has experienced repeated financial crises due to its central bank's lack of credibility. Frequent government interference, inconsistent policies, and high inflation have led to a weak currency and slow growth. In contrast, countries with credible central banks, such as Germany and Sweden, enjoy stable economies and low inflation. Conclusion: central bank credibility is essential for economic stability and growth. When people trust a central bank, inflation remains under control, interest rates stay low, and markets function smoothly. However, when credibility is lost, inflation rises, borrowing costs increase, and financial stability is threatened. Building and maintaining credibility requires independence, clear communication and consistent policies. Countries with strong central banks such as the US, Canada, and Switzerland enjoy economic stability, while those with weak central banks like Zimbabwe and Argentina face persistent problems. In a world of economic uncertainty, central bank credibility remains a cornerstone of financial stability. Without it, economic policies lose their effectiveness, leading to instability and hardship. Therefore, preserving the trust of the public and financial markets should always be a priority for central banks worldwide. Stay tuned, money enthusiasts.